Welcome to The Explainer. I am absolutely thrilled to have you here today because we're doing a deep dive into something that has the financial markets seriously buzzing right now. We're tearing into the Indo-MIM IPO prospectus. Look, if you love dissecting business fundamentals and you really want to uncover exactly how a company operates before it hits the public markets, you are in the exact right place. We're going to break down the raw numbers, the core business model, and the real-world facts driving this massive public offering. So here is the million-dollar, or should I say, the multi-crore question to get us started. What exactly powers a 3,811 crore issue in the precision engineering space? What is so fascinating about Indo-MIM is that their technology is literally hidden in plain sight. From the cars we drive every single day to the life-saving medical devices surgeons use, this company is quietly manufacturing the critical components that make the modern world run. And yet, most people have never even heard of them. Well, today, we are going to change that. Let's look under the hood of this manufacturing giant. Okay, let's dive into this. Here's our roadmap for today's explainer. First, the business model. Second, the financial growth. Third, the IPO details. And fourth, the key risks and weaknesses. Section 1, the Indo-MIM business model. From Bangalore to global leader. Before we get lost in the financials, we really need to de-jargonize what this company actually does. The secret sauce here is MIM, which stands for metal injection molding. Think of it like this. Plastic injection molding is famous, right? Because you can create incredibly complex shapes super cheaply and quickly. But obviously, a piece of plastic isn't strong enough to sit inside a firing car engine or an airplane. Well, MIM solves this. It combines the wild design complexity and mass production efficiency of plastics, but with the sheer durable strength of metal. It's highly technical manufacturing made totally scalable. And their scale is honestly staggering. Since their founding in Bengaluru back in 1996, they haven't just grown, they've exploded. They aren't some small local player. They are the world's largest MIM manufacturer. We're talking 15 manufacturing facilities spread globally across India, the USA, the UK, and Mexico. They command an estimated 6.8% of the global market share in this highly specialized cutthroat niche. That is a massive operational footprint. Now, I know what you're probably thinking. Metal molding sounds, well, a bit dry. But that completely changes when you realize who is actually buying this stuff. Their industry diversification is wild. One minute, they're making automotive turbochargers and fuel injectors. The next, they're in the defense sector, making actual components for missile guidance systems and small arms. Then they pivot to medical surgical tools and implants, aerospace engine parts, and even the tiny, hyper-precise components inside luxury watches. They are deeply, deeply embedded across multiple high-barrier-to-entry industries. Let's move to Section 2, accelerating financial growth. Time to look under the hood. The revenue trend we are seeing tells a very clear story of acceleration. In FY24, they brought in 2,870 crore. That bumped up nicely to 3,330 crore in FY25. But wow, look at FY26. Revenue absolutely surged to 4,193 crore. That represents a massive 25.9% year-over-year revenue growth rate. They aren't just growing, the actual pace of their growth is speeding up right as they head into this IPO. But hey, we all know revenue is just vanity if you don't have the profit margins to back it up, right? That brings us to this standout number, 25.54%. That is their EBITDA margin for FY26. To maintain margins that high in heavy manufacturing, you need a serious edge. Indo-MIM pulls this off through a clever high-margin model driven by cost arbitrage, basically producing in India for big global clients. Add to that the fact that they produce their own metal powder in-house. By controlling their raw materials internally, they're capturing all that margin that would normally get paid out to third-party suppliers. And naturally, we see that top-line growth and those juicy margins translating directly into bottom-line profits. Profit after tax, or PAT, surged to 533.5 crore in FY26. And just as importantly for anyone thinking of investing, they are deploying their capital super efficiently. They're boasting a 26.60% return on capital employed, or ROCE. So they are generating really solid returns on the cash they've poured into those 15 global facilities. All right, Section 3, exploring the IPO details. Let's break down the deal structure. Okay, here are the vital stats you need to know for this offering. The IPO runs from July 23rd to July 27th, 2026. The price band is set between 461 and 485 rupees per share. Now, pay close attention to how this issue is split up. The total issue is a huge 3,811.21 crore. However, the vast majority of this, 3,311.21 crore to be exact, is an offer for sale, or OFS. That means existing shareholders are taking some chips off the table and cashing out. The fresh issue, which is the money actually going directly into the company's pockets, is 499.10 crore. Oh, and if you happen to work there, employees get a 45 rupee per share discount. Now, what's really interesting is looking at exactly what it costs to get in at the different investment tiers. For a standard retail investor, the absolute minimum is one lot. That's 30 shares at 14,550 rupees. The retail maximum caps out at 13 lots, or just under 1.9 lakhs. If you want to step up to the small HNI category, you'll need a minimum of 14 lots, which costs roughly 2 lakhs. And for the big HNI players, you're looking at 69 lots, requiring an investment of just over 10 lakhs. It's a very cleanly structured setup across all the investor classes. So what exactly is the company doing with that 499 crore of fresh capital? Well, their primary objective is deleveraging. Cr IPO for FY26, their debt-to-equity ratio sits at 0.39x. Honestly, that's already relatively manageable. But post-IPO, they plan to take 400 crore from that fresh issue and use it specifically to repay borrowings. This aggressively reduces their leverage and scrubs the balance sheet clean, giving them a really strong foundation for future growth. The rest will just go toward general corporate purposes. To give us some much-needed market context, the prospectus lays out peer valuation comparisons. At the upper price band, Indo-MIM's PE ratio sits at 39.5, with an EV/EBITDA of 26.2. They've listed peers across totally varying sectors here to show different market multiples. You got Sola Vineyards at a 48.7 PE, Var & Beverages at a lofty 71.3 PE, and BLSE Services down at 22.1. While these certainly aren't direct apples-to-apples manufacturing competitors, it gives you a solid baseline for how the broader market is currently valuing established, fast-growing companies.
Section 4. Key risks and weaknesses. It is time for the reality check.
So, the crucial point here is understanding exactly where their bottlenecks and vulnerabilities lie. First up, they have a massive export reliance. About 77% of their revenue is international, and a whopping 43.6% comes just from North America. Look, if the U.S. economy catches a cold, Indo-MIM is going to sneeze. Second is customer concentration. Their top 10 customers account for nearly 40% of their total sales. Losing just one of those big contracts would seriously sting. Third, despite making their own powder, 60.9% of their raw materials are still imported, making them pretty vulnerable to global supply chain shocks. And finally, their Indian production facilities are highly concentrated geographically in Karnataka, Tamil Nadu, and Andhra Pradesh, exposing them to regional risks. Which leaves us with this final, thought-provoking question. We've seen the incredible scale, the industry-leading margins, and the frankly awesome revenue growth. But we've also unpacked the heavy reliance on North American exports, massive customer concentration, and some real global supply chain dependencies. It is a classic tension between a totally dominant market position and very real-world vulnerabilities. So armed with all this due diligence, what do you think? Is this precision-engineered IPO the right fit for your portfolio? Well, that is something you're going to have to decide. Thank you so much for joining me on this explainer. Keep learning, and I'll catch you next time.